There we go. This mic works. Hey, that's good news. Hey, good morning, everybody. How you doing? You looking good? There we go. This mic works. Hey, that's good news. Hey, good morning, everybody. How you doing? Well, it kind of sounds like a repeat, huh? There we go. Got through the loop. Figured that out. Guten Morgen. Comment allez-vous? How are you? Welcome to Trade Non-Farm Payrolls Live, a collaboration between FX Bootcamp and FXStreet and Trader's Way. This goes back now 197 months. 197 months. So congratulations to FXStreet. I think that's amazing. I think our relationship is awesome. I think this is... you know, what? It's got to be close to world record, isn't it? Oh, you have an echo? Do I have more than one mic working? Let's see. Check, check, check. Check, check. No? Maybe there's a lag. I get it. There's probably a lag. There was an echo a minute ago. Okay, there's a bit of a lag. Let me wave at the camera. Now I can see what the lag is. But anyways, yeah. Yeah, X-Trader's probably got the webinar on twice, huh? Yeah. So anyways, hey, my name is Wayne McDonell. I am a currency trader just like you. Been doing this a very long time. A little bit about me. Well, it all started when I had two paper routes. And then I worked at hockey games, eh? Yep. Skip ahead a little bit, Wayne. Okay. My first, what would you say, real job was working at NASA. See, I was on my way to be as Americans say, astronaut. What's an astronaut? Anyways, I wanted to go to space. I wanted to fly and I wanted to go to space. So I worked at NASA. Very cool. I mean, an epically cool job, actually. Got some cool stories about that. And then I joined the military. I was Top Gun qualified, passed all the written tests. I did all the interviews. I was good to go. I was locked and loaded with the United States Navy. And on my first day of medical testing, I peed in a cup and they're like, "You're diabetic." And I'm like, "So what?" So they put me on the red line and it took me to a counselor. And I'm like, "Does that mean I'm not going to fly airplanes?" He's like, "Son, I wouldn't give you a rifle, yet alone a $25 million airplane." Yeah, Johnny's like, better than a cosmonaut. For sure. So who? Wow. So I said, well, I guess I'll be a businessman then. And that's what I did. Fast forward a few years, I'm running a company of 3,000 people on the board of directors of the corporation in New York City. My first board meeting was on Broad and Wall Street, right at a big, powerful law firm. It's just awesome. They elected me to the board of directors. On that board of directors included the vice president of General Electric, vice president of Arthur Andersen, the president of AT&T, a representative of the United Nations, and somebody called George Soros. This was 1995. Good start to the business world. Hey, not bad for, I must have been, I don't know, 21 or 22. That's pretty good. Skip ahead, skip ahead, skip ahead. High-tech entrepreneur in Silicon Valley, Apple, Cisco. Skip ahead, skip ahead, skip ahead. Became a venture capitalist. Skip ahead, skip ahead. And then one day, I think I'm super happy. I have a big, beautiful office. Our firm had two entire floors of a building right next to the San Francisco Fed. I had views of the San Francisco Bay and the Bay Bridge and Treasure Island. Epic, epic. Epic. And you're like, man, I'm on top of the world. Quite literally. But, you know, like, I'm doing what I love. It was really cool. Everything was nice. And then I ran into this thing called Forex. Traded demo account for a couple of years until I was doing Forex more than I was doing my job, but I realized I don't like mediocrity, so I was starting to do my job less good than I could have because I was so focused on Forex, but then I realized I could get better at Forex if I wasn't doing my job. So I had to make a leap of faith, so to speak. And after trading a demo account for a couple of years, I said to my boss, take this job and shove it, and I became a full-time Forex trader. That was about 20 years ago. So here I am. Nice to meet you. Now, I'd never traded anything before, so I started with technical analysis, and that's where I ran into FXStreet. They were already providing good content for retail Forex traders. There wasn't webinars and live streams yet. YouTube hadn't been invented. Amazon.com had not been invented. This shows you how far back this was. And so there was some chats with some experts, and then there was some content related to Forex trading, and that was it. That was one of their first live webinar guys. Cool, right? Very nice. Later on, after I got, better and better technical analysis, what it told me was I don't see the whole picture. I'm missing something. I realized technical analysis is a great place to start, but it was very, very clear to me that I was missing something. And of course, that was fundamentals. Fundamentals. You have to remember, I wasn't a trader. I wasn't an economist. I was a venture capitalist. And so I was an investor, but I wasn't an economist. Didn't know anything about macroeconomics. Literally didn't even know it existed. So if you're probably light years ahead than where I was. So I got better. I spent time teaching myself fundamental analysis because I had taught myself technicals. When I got licensed and registered with the National Futures Association, I had to pass the Series 3 exam, which is a very tough exam, and it was all fundamentally related. So that's where I learned fundamentals. But then I still didn't have a background in economics, so then I went to this little private school called Harvard and got a macroeconomics degree, not a certificate, a degree. Actually, I got 2 degrees. No. But who's counting? I am. Further to that, I studied cryptocurrencies at MIT with Gary Gensler, who now runs the SEC. He was my professor. He ran the NFA, then he taught at MIT. I was in his class. And then as soon as my class was over, he took over the SEC and now is trying to regulate cryptocurrencies. Did some alternative investing at Harvard Business School, and then I did more postgraduate work at Oxford doing their algorithmic trading program. So that's me. So I've learned a few things over the last 20 years, and I hope to continue to grow, and I hope I inspire you to continue and grow, to continue growing as a trader. If you are doing this 20 years from now, I hope you're still as interested as I am, because I truly have a passion for what we do, and I love working with my fellow retail Forex traders, you and I. I love doing these webinars. I love being part of a community of traders. It's very important to me. Keeps me razor sharp, but also the relationship is super important. When I went full time, 20 years ago, the risk that I did not analyze, because you remember, I had to decide whether I wanted to quit my dream job and become a Forex trader, not quit my stupid job to become a Forex trader. So I analyzed it, and that's why I traded on a demo for a couple of years to make sure that I was good enough to do it. And then when I became a full-time Forex trader, what I didn't calculate as a risk is the loneliness and the isolation. And that hit me hard, actually. That was like a sledgehammer, the isolation. Back then, I traded from 10 o'clock at night to 10 o'clock in the morning because I lived in a place called California, IA. Okay? Yeah. So Trading Twist says, wants to do a market review. Okay. Did I do the disclaimer? I'm going to do the disclaimer again, even if I did it. Let me remind you that trading is risky. Not, right? It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Therefore, always stay small, stay humble, focused on the long term, and never risk money you cannot afford to lose. Okay? John says, I wrote a book. I did write a book. So when I wrote the book, I'd been coaching, because I have a coaching service. I had been coaching for, 5 or 6 years. I had spoken at conferences around the world. I was writing magazine articles. I ran something called the Currency Corner in a magazine. And anyways, I got approached when I was in New York City. Wiley Publishing came up to me and said, hey, wow, you clearly have a large following. Have you ever thought about writing a book? And I'm like, yep. And they're like, oh, cool. Do you know what it'd be about? And I said to them, well, I can send you the table of contents. And they're like, what, really? I'm like, yeah. So I did. Now it became a book. So if your modality is learning by reading, there is a book, and it's an honest book. I think when you start reading it, it says, when I first started trading Forex, I sucked as a currency trader. I worked at it really, really hard, and over time, I sucked less and less and less. 20 years later, I suck less than when I started. Yeah. I'm not the best trader in the world, but I have a lot of experience that I could share. When you're on YouTube, the average expert's only been trading for 5 years, maybe less. Can you imagine that? You're taking advice from them. They don't have 20 years of experience. See, that's what I like about FXstreet. Their experts have been trading for years and years and years. And they've been through the good times and the bad time. Okay? All right, so help you with the market review. I'm going to share something with you. And it's a new, right? I started a new service called QuantBox. It started when at FX Bootcamp. So, I'm with tradersway.com, an ethical, trustworthy foreign exchange broker. I recommend you open up an account at tradersway.com. Okay? I've been running FX Bootcamp for 20 years. That's my educational service. It's $88 a year. You sign up and you get instant access to 65 hours of hardcore training, swing trading, position trading, price action, technical analysis, monetary policy, macroeconomics, trader psychology. It's all there. $88. Obviously, I'm not trying to get rich selling something for $88. It's going to overwhelm you with the amount of value. Now, in my swing trading group, one day there was 20 or 30 of us getting together, and I was trying to teach a new way, or not a new way, but yet another way of doing fundamental analysis of economic data. And so we opened up a spreadsheet on Google Spreadsheets, and we were collaborating, right? And I started building tables. And and this is what we started building. Let me get my pen. Okay, we started building this area here. Okay, and so I sent people out across the web, and we started gathering information for every currency, every major currency that we trade, interest rates, unemployment, inflation, GDP, and I think that was it. And we built this spreadsheet. And we spent time on it, and we gathered information for all the pairs. And then we realized, holy smokes, there's more to it than that. So the next week we got together and we added new columns for the change in unemployment, the change month over month, this differential stuff. Okay, on the fundamental side. So not just GDP growth, but in the Eurozone, is it going up or is it going down? Inflation, is it going up or is it going down? Okay, so we had more columns. And then we went through all of that, and then we kind of scored them up. And then we found out some people made mistakes. They put in quarterly GDP and other people put annual. So then we had to go back, and all of a sudden we're like, this is so prone to mistakes that it's going to be a problem. So now, actually this isn't, I have a different one. Where is that one? Hang on. Well, this will work, but I have a different version of this. Anywho, let me get the other one. Hang on. Just in case this is the wrong one. I think this is just named differently. Let me close that, open up this. There you go. I think you're going to see it's the same. Okay. All right. Just want to make sure. Okay. So anyway, so we went through and we did that information. We gathered that information here for every currency pair, and we scored them. And what we were saying is, how is euro, here we go. How is euro doing relative to the dollar? Not subjectively, but quantitatively. What is the fundamental trend? But again, the what worried me was, what if somebody inputted data into the spreadsheet incorrectly? And in fact, when we built it, they did put the wrong data in. So you would have to constantly be checking it. But then every time there's new news in Europe and New Zealand and Australia and Canada and the United States and the UK and Europe, you'd have to update it for inflation, GDP, and all these areas. And all of a sudden, I'm like, oh my gosh, the possibility of a mistake is really guaranteed. You're going to make mistakes. And so I said, well, what I need is an automated process. And so QuantBox is a new service that I have. And what it does is it uses artificial intelligence that sits on the Google Cloud, pulls in the data automatically and scores everything automatically to give you a quantitative overview. But then I wanted to add more data, okay, than what we originally did. And the new data would also be like the COT data, okay, extrapolating out retail sentiment, throwing in some seasonality, and then throwing in the technical trend. Because remember, AI can do it automatically. For a human, that's tedious work. That's nonstop. Right? Like, you have to watch now all of this stuff in real time on all pairs that you trade. And then, right? And commodities and all that kind of stuff. So this is for the S&P 500. I'm like, oy vey. That's difficult. So anyway, so it's now automated. It's cool, right? So let's do the market review. And this might be a tool that you would be helpful in doing your market reviews. Okay, one of the things you want to look at as of right now, and this was different last night, by the way. This is real time. Okay? And look at oil. Yesterday it was way, way, way low. It was way low the other day. And now it is popped right up. This is the German DAX. Okay? So this report was this report's like 10 minutes old. Okay? Now, we can go through this and we can take a look at things like this is how the retail market and the institutional investors are positioned. So we can go through all of this too. So it's not just it's not just fundamental analysis of economic data. It's the fundamental analysis of the flow of capital. Okay. So if you want, I can give you a copy so we can go through this together. I popped together, I don't know. think it's going to be over here. Would you like a copy? I just set this up 15 minutes ago so that you can download a copy. It should just give you access, right? There's no like email sequence set up. There's nothing set up. It's just going to give you the access to download the file. That's it. There's literally nothing else to it. Cool. So anyways, we can go through it together. What it's doing on the left here is what you'll see is it's telling you the strongest buys based on the economic data. And CAD yen, for example, has the strongest buy. Now, how does it get to that conclusion? Well, it created a score of 7, looked at the COT data, and it doesn't really, right? In this one, here we go. We're looking at the COT data, and institutional investors are positioned to buy CAD more than they want to buy yen. Okay? Retail traders are more favorable to CAD than yen. Seasonality, CAD yen typically goes up this period. The trend is very, very strong technically and scores even higher, right? The 2, you see how it's scoring 2? So the COT data is very heavily favored in Canada, and the technical trend is very heavily favorable to the CAD. GDP growth is better for CAD, but look at this. Inflation's lower in Japan. Unemployment is lower in Japan. But the interest rate differential of this pair favors Canada over Japan. Okay? So now there's no opinion. If you add that up, the framework, think of it as a model. The framework, the scoring of the economic and technical and flow data favors a long CAD yen. Doesn't mean it's an instant buy, but you would then use that framework to say, hey, should I be looking at purchasing CAD yen? Okay? And you're looking at the right thing is what it's doing. Hey, good morning, Lucas. Okay. Did anyone opt in to get the report? I just want to know if it works. I just literally created it just for this live stream. It did? Awesome. Yeah, my pleasure, James. Cool. Nice. Isn't it nice when something actually works? Crazy. Crazy for loving you. All right. So anyway, so now you're looking at this chart, and now you still have to be a technical analyst. All the trend was doing was looking at the 5, the 8, and the 21 EMAs, not on this chart, actually, on the daily. And all it's saying is, yeah, this is bullish, and that's it. And it's very bullish, right? The angle and separation between the 5, the 8, and the 21 is very bullish, and therefore scored a 2. That's all. Now, an algorithm's stupid. Humans are smart. So you could say, well, should I be worried at some point of this higher level above us? Let's say this zone. Yeah, that would be worrisome. But maybe you'd be less worried now that you're scoring the fundamental data to say, okay, look, as a technician, we recognize that when we get here, there's going to be a pullback. But fundamentally, this is very bullish. And one might assume that the fundamental trend, and remember, it's not just analyzing economic data, it's actually analyzing the flow of capital. How are retail traders positioned? How are institutional traders positioned? That's the flow of capital. Where is the money going, honey? Right? Follow the money. So it's looking at because the money is flowing up in this case because the economic data suggests up. And now even the technical trend suggests up. But we know every uptrend has pullbacks. So like during this period here of 2 days of down, 2.5 days of down, that might be the thing you're looking for to buy because you only buy low. So you could have bought it here off the 21. You get that? Where you're like fundamentally up. Analysis of capital flow, up. The technical trend is up. But then we got 2 red daily candles. Oh my God, that's what you're looking for. Okay? So that's how you put that together. Okay? Wah says, hey, what do you expect about non-farm payrolls? And then he says it in caps. Dude, FXStreet is full of information about what to expect for non-farm payrolls. Okay? It's a data point. It's going to come out. Is it going to be 300,000, 350, 250? Is it going to be 500? I don't know. I also wrote a whole report how to create your own model, so I'm assuming you've done all that work. But haven't you been to like 5 different websites telling you? Haven't you been watching TV, like let's say CNBC, and they have talking heads coming out and giving your predictions? I honestly don't really care that much about what the headline number of NFP is. Why? I'm a macroeconomic fundamentalist, right? I'm a trend trader. So I'm trading the trend in non-farm payrolls, which leads to the central bank having a policy. I already know what the policy is. The policy is already in play. So the only question is, will the Fed change its policy because of this NFP? Well, dude, it would have to be such a crazy outlier. It would have to be redonkulous. Plus 600,000 or let's say 100,000 or even a negative number. But that's not likely. I'm assuming you looked at the JOLTS report and the weekly jobless claims report, the ADP report, and you concluded, okay, wah. But if you really don't know what's going on and you really have no idea, you should cool off, dude. Cool off. Simmer down. You're not going to get rich today. Okay? Park the yellow Lamborghini, son. Relax. So again, this is one data set, one data point in a set of data. The set of data has a trend. The trend is interpreted by the central bank. The central bank has carried out a policy. And we're 3 weeks away from the next meeting where they will, affirm the policy or change the policy. Okay? Kevin says he feels like they want to stay the course. Isn't that what they just said at Jackson Hole? So again, we know all of this stuff. Okay, Wah? You're supposed to know all of this stuff already. I'm not talking about any proprietary indicator. I'm talking about just this is what's happening in the world, and I hope you understand that. So the NFP number is going to come out, and I'm going to put that number into my model, and it's probably not going to change anything. Yes, we'll probably get some vol. If it's a big number, they're going to say, oh my God, the Fed rate hikes are not having a positive effect, and the stock market comes down. If it's a really low number, people are going to say, oh my God, the Fed's policies are working. We've hit peak inflation and the labor market's starting to slow down. That's great. And the stock market's going to rally. So bad news will probably be good news. Good news will probably be bad news. But what will happen would be probably about as expected. Now, if I were to guess, I would say based on things like the JOLTS report and other economic data that's published, it's already known, that it's going to be higher than expected. I said that last week, and I went through the 9 different pieces of information I used to get to that. And I said, this is going to be much higher than expected. And it was much, much higher than expected. And I'm like, see? I mean, look, all the information's out there. It's not complicated. Where people go wrong is they don't do the work. Okay? Cool. So I want to go on to things that matter more than that. Okay. And so let me pull up the report again. There we go. Okay. So you can see some of the strongest trending currency pairs right now. To the upside, you got Aussie Swiss franc, Aussie yen, Aussie Kiwi, Aussie dollar. Actually, Aussie dollar is negative. So what does this tell you? As of right now, Aussie's doing well, and the US dollar is doing better. CAD Swissy, CAD yen. Obviously, CAD is doing well. These are just the technical trends. This is not fundamental. It's just the technical trends. So those are good trending. So we might want to look at CAD pairs today, and we might want to look at Aussie pairs today. The biggest downtrends, Kiwi CAD. Yeah, but check that out. We see CAD is doing well on the left, and now the CAD pair is on the right here, right? Pound CAD is doing well, Pound Aussie is doing well, Pound Swissy is doing well, Pound Kiwi is doing well, right? But all to the downside. And so you'll see that it looks like CAD is strong, and Aussie is strong, and Pound is weak. And these are all the best technical trends. This is the COT data, but that's going to get updated today. And then here's the retail positioning. Check this out. 98% of retail flow is going long Kiwi CAD, and yet it's the strongest negative trend that we have today. Look at this. Retail is buying, and the trend is down. Retail is buying, retail is long, and the strongest downtrend is Kiwi CAD. Retail's losing money today on that pair. Cool. So here's the position of retail traders right now on the left. Okay. Long Kiwi CAD. Short USD Rand. Okay. So on the top is the biggest long, on the bottom is the biggest short, and everything in between. Retail's buying Japanese yen right now. Okay. They're buying Kiwi and they're buying Pound. So we might want to probably sell those things. Okay. What to expect from the news. So let's go into here. In the United States of America, right? We have non-farm payrolls today. Okay, and you can see that we're expecting 300K. We're expecting, okay, unemployment rate to stay the same. What we probably want to see is like participation rates change, right? Where people are dropping out. Kevin says, why do they want to trade against the trend? Well, I think unfairly, when you look at data like that, the market calls it dumb money, and the smart money is the institution. I don't think it's fair. I think, Kevin, there might be some of that counter trend stuff, but I think retail traders are just shorter term trades. So even though the trend might be very strongly down and the COT data is very heavily favored to selling, there's up moves. Okay. And so retail traders trade on a 5-minute chart and a 15-minute chart, and they might be long for a while, and then it rolls over and goes the other way, and they get stopped out, and it falls to the next level. So I think it's just misunderstood, right? I don't think the retail traders are wrong. I think they're trading on a different time frame. When you're doing institutional trading data, these trades last for weeks, not hours. Okay? A lot of retail traders are only in their trades for a very short amount of time, right? Right? And there was another point I was going to make, but I forgot. But anyway, so I don't consider it dumb money. It's just different. Different time frames, different outlook. But in this case, they're probably wrong. What do I mean by probably? Well, analyzing the economic data, they might be in a situation where they're buying and making money, but fundamentally it makes absolutely no sense. Now, most retail traders don't do any fundamental analysis. They're just purely technical. So they're making short-term technical decisions, and I hope they're making money. They might be making money. I mean, look, if you're only pulling 10 pips out at a time, right? Chipping away, you make 10 pips, you make 10 pips, you make 10 pips. Okay, you're probably making money in those scenarios, although it's hard work. But on the long run, they're trading in the wrong direction, and they'd much be better off being short-term short than short-term long. But again, I don't call retail traders dumb. Okay? It's different. So anyways, one of the things you want to look at, like average hourly earnings should be the same, unemployment rate should be the same, all that kind of stuff. But what it doesn't say on here, well, I guess it's this one. This is the one that we're looking at here. Oh, get it highlighted. That's the one we want to look at, the change in participation rate, where maybe the unemployment rate's not falling, but people are dropping out of the workforce, which is the same as losing a job. We're losing a worker in the workforce because they've been looking for a job and they can't find one. Now, going back to the JOLTS report, this country has added hundreds of thousands more jobs. There's actually now officially 2 jobs for every worker. The problem is if you've dropped out of the market because you can't get those jobs, you have a skill that people don't need. So excuse my French here, but maybe you are good at folding bed sheets. But Marriott doesn't need you right now because business travel still hasn't returned to the peak levels. And so their hotels are at 80% capacity instead of 100% capacity. So you're like, well, I can fold sheets. And they're like, yeah, that's cool. Maybe next year we'll hire you. However, I use the example of a friend of mine. She's married. She has 2 kids. She had a full-time job. But despite all of that heavy workload, she went to Stanford at night and studied artificial intelligence for a year and a half, 2 years, and got a graduate certificate in artificial intelligence. Heavy math and programming. And the day she got the certificate, she got hired by Apple Computer in their AI department. The same day. So you can just do that. Here's the funny thing. You tell that to people and they're like, I could never do that. Well, whatever. This is what the American economy is demanding right now. So for people that have no excuses, oh, I'm married and I have a job. My life's too busy. Oh, I'm married. I have a job and I have 2 kids. I'm just way too busy. Well, give up vacation, give up nights, give up weekends, give up holidays, cancel all your fun, and sacrifice for 2 years. If you can do that, that job's going to pay you $350,000 a year because you got what it takes. That's how I look at Forex too. Trade a demo account for 2 years. Don't trade your money. But Wayne, I got to get rich quick. You're Oh, I almost swore. You're delusional. I want you to think about that. If you're here to get rich quick, you're delusional. You should probably rob a bank. You'll get rich quick. There's risk involved in that. It's not ethical. You'll probably go to the jail the rest of your life and find a whole bunch of other people that also wanted to get rich quick too. They might have decided to sell drugs or prostitution. Hey, it's quick money. It's easy. Why don't you do that? But if you want to build a business that creates value, and it's going to take sacrifice and investment for years and years and years, and I would tell you, don't trade real money for the first 2 years of trading Forex. Instead, develop skills, repeatable skills, and increase your knowledge, increase your experience. And in 2 years from now, if you're focused and driven, you will be an amazing trader compared to what you are now. And maybe you're pretty good now, but in 2 years, you'll be amazing. And if you've been saving money for 2 years along the way, you're going to up your game. You're going to up your game from street ball to college ball to NBA, and then start trading real money. That would be my advice to you. Get a second job, save all your money, and up your game from a D game to an A game. Okay? Yeah, John's like, it is, right? Robbing banks used to be good pay, short hours. Now banks are too sophisticated, so now you got to rob liquor stores, but now they have shotguns under the counter and will shoot you over $100. Okay? All right. You guys want to talk about the stock market? Okay? Very cool. I started shorting the stock market around 4,300. Now, I'm long, of course, on long-term long. Obviously, I have retirement accounts and investment accounts and all that kind of stuff. So I saved money, by the way, and there are plenty of people here that can confirm this. I saved money for about 6 months. Because I expected the stock market to fall 10 to 20% in January, in early this year, January or February of this year. I saved money for 6 months because my models, my analysis suggested that the stock market was going to crash, and I was waiting to buy. My clock must be off. Really? Is it that close? It is. All right, will someone post the number, please? My microwave is off 5 minutes. Holy smokes. Yeah, if someone could pop the number, that'd be great. I'm just going to zip over to Euro Dollar because that's probably what everyone is watching. $3.15, beautiful. As expected, continue mission. I would sell the rips. That's what the Wayne would do. I would sell the rips. So I want to look at those. So some people are going to say that's good, and others are going to say it's bad. And so I'm looking to sell high, Bubba. Maybe that one. And I'm just going to try to line up this one in here. Sort of in there. Okay, 315 is as expected. Not a big deal. Won't change anything at all. It is less than before, right? And maybe people are going to look at that as that's the good thing. They're like, okay, it's way less than before. But to me, fundamentally, it doesn't change anything. So selling the rip. Okay. So unemployment changed. Okay, that's interesting, right? So that's a small sign that things might be working. Very cool. Labor force participation rate increased. Wow. It's interesting. It's still low, but it's going up. That's the opposite. Look at this. The numbers of persons not in the labor force who currently want a job has fallen. They're not looking for a job, so they're not counted in the workforce. But now they don't even want a job if you could give it. Simon says it isn't much. No, it is. It's a lot. It's a lot. Mathematically, it's a lot. 6.5% of people are still worried about COVID and working from home. They're going to get fired pretty soon. I mean, I think CEOs are pissed. I think they're like, if you have COVID, put a mask on. Come to work, get your crap done. And then maybe the person working in the cubicle next to you, they'll decide to wear a mask too. But you're like, oh, I don't feel good. I'm going to work from home, a.k.a. play Call of Duty all day. No, you're fired. If you're that kind of person, you're fired. I think there's a lot of people abusing the system. I think some people are really sick, but very few people have to go to the hospital now because they have COVID. You're like, oh, I have a COVID cold. I can't come into work. Hey, if you're playing the game, if you're gaming the system, you'll get fired. You don't have what it takes. If you're gaming the system, you're trying to find a way to make a buck on somebody else's back, you're not going to be around that long. And by the way, when you look at the productivity has fallen a lot as people have been hired. And so those people will get fired too. The new workers are very low productive workers and they're getting paid higher wages. That's not going to last very long. So as soon as this economy does slow down, and what the Fed is doing will slow the economy down, those people are going to get fired first. They got hired last and they're going to get fired first. Okay? So anyways, let me give you this. Okay. So there's a question here, gloves for socks. Is S&P 500 going to be up or down today? Well, what's your interpretation of the data? I interpreted the data as nothing has changed, and I said sell the rip. So it went up, hit my first level of resistance, and it stopped. Okay. So like looking at Aussie dollar, okay, what we're looking at is keeping it below, let me mark it this way, keeping it below this zone here. So I can move my stop, for example, lock in some profit. I'll lock in 100 pips. No, that's 122. All right, I'll lock in 125 pip. No, shoot, that's 150. Let's see. No, I'm wrong. No. Okay, that's I can't quite get it. All right. I'll lock in 100 pips profit. And we should be fine from now. Okay, Glove says, I think up because the Fed will hike less. Okay. That's fair. Oil is moving. Yeah, of course it's moving up. Yeah, let's zip over. Let's do commodities. Let's do gold, oil, and Bitcoin quickly. Okay, my WTI. So, Johnny, earlier I showed my economic report right before non-farm payrolls. So let me pull up the report again. Here it is. And on the main page, I showed right away the biggest mover to the upside is oil. Look at that. Relative to everything else, it's up like almost 2%. And this is before the news. So yeah, so you would know that right away, like, oh my God, look at the DAX, look at oil. Holy smokes. Okay. So let's analyze the S&P 500. Right now the trend is down. This is again right before the news. And we're looking at price projections going out 7 trading days. And one suggestion is we go up, we tickle 4,000, and then we drop back down. And we follow the glide path of, let's say, 1 standard deviation above the mean. Right? So 1 glide path is up and then down. Okay? So let's do it this way. Let me change the color slightly. Okay? So really the glide path is in this zone. Between, right? Between those. Red meaning down. Well, I guess they're all down. Even green going to be down. But this is faster down. So that's the projection. It's looking at the slope. It's calculating the slope, right? The mean. So you look at the mean. And then you extend that mean out. And of course, the math is just rise over run. Then the second one is looking at the variance and calculating the standard deviation, right? You guys probably know this. I'll cover just, right? So you have to do M is equal to the mean, the slope of the mean, which is rise over run. So you have to break this into a quadrant, right? Do a little trig or calculus, and you'll see that there's an intercept and all that. So the formula, by the way, is y equals, that's a y, mx plus b. And then we've already calculated m. So now not only do you want the mean, but you want the rise over the run. And you'll see it's a negative rise over the run, so you get a slope. Then you calculate from the slope, how, the slope being like this, how far above and below has price in the past tended to deviate from the average, so that you get a variance. And then you square root the variance and you get the standard deviation. And you're projecting that out forward 7 days. So you got the average, 1 standard deviation above the average, and 1 standard deviation below the average, so that you're basically looking at the variance. Make sense? So if we have a little up, we probably want to look to sell. And now, of course, if it does change dramatically, so we're up in here, and the price wants to do something like this, well, then the technical trend will change, and this score would drop from -2 to 0, and that would pull it to no longer bearish. You see? So right now, the S&P 500 is neutral going into this news. So we'll see on Monday, this might change, but fundamentally, right? Fundamentally, things are okay on this. Okay? Can somebody give, do I still have the link? No, I have the wrong link. Wah doesn't have the report. Come on, Wah. Here, I'll give you the link. Here's the report, Wah. Okay, so anyways, how many people here trade gold? Yeah, isn't it amazing, Darko? Teachers don't explain it in a way that I think they could, but maybe they don't understand how people use that information to make money. They do lectures to make money. But if you're like, oh my God, people use this to invest? Okay. All right. So anywho, we're looking at gold. Okay. One of the things you might want to look at here is over this July and August and period, gold was going up. And for 6 weeks, I said, I'm a bear, I'm a bear, I'm a bear. Gold went up for 6 weeks, and I'm like, I'm a bear, I'm a bear, I'm a bear. Now, there's lots of reasons for it. I understand the flow of capital, so I don't need to see a lot of this information because I have it in my brain. It's just nice that there's a tool that does this now to tell you. But look, we all know people buy gold to hedge against inflation. So you might be saying, well, Wayne, we have 10% inflation. Why is gold falling? Dude, you don't buy gold after inflation has already gone to 10%. It's like buying insurance after your house burned to the ground. You're supposed to buy insurance before your house catches on fire. So when inflation started going from 2 to 3, 3 to 4, that's when you buy gold if you think it's going to go from 4 to 5, 5 to 6, 6 to 7, 7 to 8, 8 to 9. And when you do that, gold goes up. Why do you do that? Because central banks are buying gold. So now that inflation went from 10, is going to 9, going to 8, going to 7, you have to understand that's disinflation. So you don't buy gold because it's at 8. You sell gold because it used to be 10. Now you might be in Europe and you're like, it's going from 10 to 15. Okay, buy it in terms of pound. Buy it in terms of euro. But in terms of dollar, you're about a year late, son. And the advice your grandpa gave you? Why, son, you should buy gold to hedge against the inflation. Well, that's good advice, but you didn't understand what your grandpa was telling you. He didn't say wait for the car accident to happen and then put on your seatbelt. So that's what's going on in my humble opinion. Okay, you have to understand. And by the way, as gold started going up, I started doing lectures at FX Bootcamp about central banking purchases of gold, proving it with the facts so I could show the change on the balance sheet in multiple central banks around the world in the purchase of gold. And then I explained exactly why it was happening. That was a long time ago. So I wouldn't be, I'm not going to be a bull on gold until the Fed really decides to stop raising interest rates. And that might be a while. You understand? Like that could be a year. I don't know. So we'll follow this information. But one of the things I wanted to show you, part of that advice that I was giving, well, gold prices were going up, and I'm like, I'm a bear, I'm a bear, I'm a bear. Okay, you can see this period here, gold is going up. But what normally happens? Well, these other times, right, are the 20-year average for gold and the 5-year average for gold, and it's more down than it is up. Is that right, Morena? Wow, that's pretty killer. That's pretty killer. So look at that. You're like seasonality. Based on seasonality, this up move is probably wrong. And then at some point, and actually, the down started earlier than that. That's just a little blip, but right. The blip is bigger, actually, right? So, anywho, that's that. So gold went up for 6 weeks, and the whole time I said I'm a bear. It's going up. Yeah, I don't. Yeah, but I understand what's happening. I understand what's happening. I don't chase like a dog chasing its tail. So it's going up. I'm like, good, you can have it. Okay. What else do you see on this information that, right? Okay. Here's oil. You see this? This is calculating oil as of yesterday. And it's saying, yeah, we have a pretty good chance of going from, what does that say? 86.61 to 88.57. And in a week, we'll be somewhere between $94 and $89. Okay, so it could really spike and then level off or stay relatively flat. But on average, it would guess, based on the long-term slope of the mean, long-term M, slope of the mean, that we'll probably make our way to 92 in a week. What do you think about that? Is that helpful information? Okay. Well, this was as of yesterday, we had this information. And it said, what was the number? 86.61. It dropped to 86. And then it's suggesting some up to 88.50, where we just touched 89 for today. So it said, let's mark this. It was 86.61. And it was 85 something, right? 80. No, I mean 89 something. 88.57. $88.57. Okay. And then by the end of the week, possibly, what was the average? At the end of the week, 92.02. Now, 92.02. $92.02. Okay. So now you'd have to use your technical and analyst skills. So the projected low was here, and that we'd be here. And then from here, what? Hit the 21, drop, up to 91, drop. And I would actually put this higher. Let's see. So it said by the end of the week, what was the aggressive move? 95.09, 95.09. Yeah, see, I'd even put it higher if I were me, but what that's showing is, I mean, that's actually scary because it could lead to like this if it's going to do 95, but it's not suggesting that. So I would say up, down, and then it just gets caught not willing to make a higher high yet. Okay. So now you have to play off every moving average. So there's going to be, there's going to be a challenge. Wrong one. There we go. There's going to be a challenge here. There's going to be a challenge here. And there's going to be a challenge here. So using price action now. Okay. Higher low, higher high, higher low, higher high. Okay. Higher low, higher high, and out somewhere in there. Okay. Retail and institutional traders are long this. Okay. Both retail and institution are long. Now it's priced in dollars. So they're, right? Institutional's long dollar and they're long oil. Okay. But here, they're long dollar and neutral on euro. Richard says, what about the weakness outlook globally? Well, that's what we're looking at. That's what's being priced in. Okay. So institutional traders are slightly bearish on euro. Okay. And there's been new money flowing into euro recently. You can see the week over week change is 0.1%, but nonetheless, they added some euro long. Okay. But US dollars very heavily purchased by institutional investors. However, 2/3 of retail are long euro dollar. So are they wrong? No. Again, I don't consider retail dumb money, but what we can surmise is that they're shorter term and they were buying here and now they got to get wiped out and then they'll turn that direction in the direction institutions are pointed. There's an interest rate differential of 2%, which strongly favors being short this. Okay? Well, not strongly. It only gets a -1, but it's pretty influential. You're going to get paid to hold this short. It costs you a lot of money to be long that pair, that rollover. Okay? Inflation is 8.5% in the United States and falling, and 9.1% in Europe and rising. That heavily favors being short, fundamentally anyways. Remember, it's a fundamental model. Your euro dollar currently has a score of -7 or a strong sell rating after adding up all the categories. First, let's look at institutional traders. We see that the euro has a long percentage of 45, and we see that the USD has a long percentage of 77. Institutional traders favor the dollar. Taking a look at euro dollar, we see that retail traders are long 64%. We consider this information useful when the market is in an extreme reading. If retail crowd is 60% or more positioned on one side, it gets a plus or -1. Currently, the euro dollar has a reading of -1 in this category. Remember, if the retail crowd is very long, we look to short. So retail traders are long euro dollar. So it's not that you short into the rise, you look for the change. So you don't short in this period, but you're ready, willing, and able to short in this period when it turns south. Is that right? You got it? You got that? It's beautiful, right? You're going to chase their stops. You're a stop hunter. Anyways, go back to this. Taking a look at seasonality, we get a score of -1. What this tells us is based on historical data, this market tends to fall during this month. Trend reading is based on the daily chart using the 5, the 8, and the 21 exponential moving averages. The more aligned they are, the stronger the trend up or down. In this case, we have a -2, strong trend down. Yet retail traders are buying it because it's been up for 2 or 3 or 4 days. That's the difference. Institutionals long because they believe fundamentally this pair should fall. Retail traders are long because it's been up for 4 days. But an institutional trader's like, dude, this has been down for 8 months. Who cares about 4 days? Okay? But that's the difference. They're both correct. Finally, let's look at fundamentals. GDP growth favors euro, inflation favors the dollar, employment favors the dollar, and the interest rate favors the dollar. Okay? But again, look at the seasonality. Okay? Look at the seasonality here. The up versus the typical down. Okay, this pair shouldn't go up until the period of October, November. In the last 5 years, it's October. In the last 20 years, it's more like November. Very correct, Kevin. Absolutely. And that would favor, in my opinion. Okay, so in January, by the way, I did a month-by-month, 1-year outlook. I did every single month for 2022. I did this presentation. It was about an hour and a half. One of the things I said was up November, December, and not up in September, October. Now, typically, I'm thinking up, maybe not euro dollar, but in other pairs, right? I'm thinking up starting the 3rd week of September. Definitely the 3rd week of October, for sure, right? But not this year. And it's precisely because of that, as Kevin says, midterm election year. So I also know the investment cycle overlapping the political cycle. And so I might be wrong because, again, it's just history. History doesn't necessarily repeat itself, but I love history and I love trading. And so in this case, I would keep some powder dry until late October. Usually I'm investing heavily in the 3rd week of September, but not August this year, not September this year, maybe the end of October. But by the end of the year, there'll be some up. That's my opinion. And I gave that in January. Okay. So anywho, let's take a quick look, return back to the market. My WTI, so we broke that down. That should give you a sense of what will happen the next few days, maybe the next few weeks. Let's go back to the dollar pivots. Okay. And what did you hear me tell you? Sell the rip, sell the rip, sell the rip. Okay. It hit resistance and fell, hit resistance and fell, hit resistance and fell, hit resistance and fell. You're welcome. You're welcome. No, thank you. Okay. Look at that, huh? Look at that. Look at that. Just redonkulous. Cool. So now we need the price action. So one of these things that could happen is we ride it all the way back and then we do this. NFP was 315, 300 expected. No surprise, no nothing. I'm sure we could dig deeper and find some interesting information, but right now we're just doing this. Cool. You guys want to do another report, or do you want me to go through it, just jump into the charts, or do you want to look at the report first and then do the charts? We can do like pound dollar next. What do you stink? %80 of retail traders are long that pair. Oh my God. Oh my God. Becky, look at that pound dollar. Great. Awesome, Darko. Have a good one. So this is our projection for pound dollar last week in the swing trading group. Okay. We meet on Thursdays. So I drew this here. What do you think of that? What do you think of that? Okay. Not too bad, huh? Not too shabby. So we had it going up to 119 and then dropping to 112. And we're 350 pips into the move. I got knocked out with 333 just because that's my standard trade. That's cool, right? What's your long-term view? My long-term view on pound dollar is this. Currently, the projection is somewhere around 115 to 112 for next week. We're breaking seasonality. But typically dollar weakens around this time of year. Okay? But right now, when you look at this, well, let's just do this. Pound dollar currently has a score of -7 or a strong sell rating after adding up all the categories. First, let's look at what institutional traders are buying and selling. We can see that the pound has a strong long percentage of 40%. And we see that the USD has a long percentage of 77. So 60% of traders are short pound and 77% are long dollar. This category receives a -1 as institutional traders favor the dollar. Taking a look at pound dollar, we see retail traders are 79% long and 21% short. We consider this information most useful when the market is at extreme reading. Currently, the pound dollar gets a reading of -1. Remember, if the retail crowd is very long, which it is, we will look to short. Taking a look at seasonality, we get a score of -1. What this tells us is based on historical data, the market tends to fall during this month. The trend reading is based on the daily chart using the 5, the 8, the 21 exponential moving averages. This gets a score of -2, so obviously favoring the dollar. Finally, we look at fundamentals. GDP favors pound, inflation favors dollar, unemployment favors dollar, and interest rates favor dollar. What do you mean by interest rates? The interest rate differential currently favors the dollar by 0.75 basis points. Okay, what we're talking earlier here is fundamental analysis of capital flow. Money is flowing into the dollar and flowing out of the pound. And despite all this, look at this, 60% short, long. So obviously down. Yet retail traders are buying the dips as it's falling. Now that's going to change as they get stopped out. When this retail sentiment reverses and goes short, then we'll really get a big move to the downside because now everyone's in favor. Right now, institutional traders are hunting the stops of retail traders. Okay? Now you can see here based on seasonality, typically starting the next month, so this is where we are now, typically by October, institutional investors flip. But that might not happen this year because this year is very strange for the pound. Here's how you get the report. Okay. So what you see this? So we could go up to 117. Retail would be making money. Do you understand that? If somebody bought it, they would drive it up to 117 and think that it's now an uptrend. But it'll hit one standard deviation above the mean. Okay, remember the math. It's only math. Remember, this algo is stupid. So it's just doing things like y equals mx plus b. Okay? Right? And then you can see the average price is right around there over this period. So retail could make money for 2 or 3 days. And then you probably want to get short again. Why? Because even if it goes up for 2 or 3 days, nothing fundamentally is likely to change. The only thing that would likely change is trend reading. But on a daily chart, 3 candles probably won't change the trend because it'll still be a lower high. Or in this case, it'll be toppish. I think what we really want is kind of like this the next week. Cool, loves it. All right, cool. If you download it, I'll have your email and I'll send you a coupon code for a lifetime discount. Would anybody like a lifetime discount? It's a brand new service. I haven't even officially launched it. This is the first time people outside of FX Bootcamp have even seen it. So I can give you a coupon code that will last for years and years if you remain a subscriber. Let's do it. So I'll just email you a coupon code. Right. And I'm really doing it just for Johnny. Johnny's going to get the discount code, but everyone else can have Johnny's coupon code too. Genius. Hey, take care, Johnny. Hope all is well. Have a nice weekend. All right. Well, I guess we still got to look at pound. Oh, well, I already did that. So I did this a week ago. So what do you think? I still think 112. We started selling this at 119. Dude, that's a 700 pip move. You should have known it. All right. What do you think about this one? No, it's not. It's for him, though, but that won't be it. And it would be Mr. Johnny. Captain Johnny. All right. Taking a look here. Yeah, Andrew, I just pulled this report right before NFP. And of course, it was different last night, so it's already been updated. Yeah, so it'll be updated on Sunday. And of course, we'll have all this and likely some COT data and stuff. Thanks, BT. Okay. All right, check it out. Seasonally, I want you to look at, because you want to look at forces for you and against you, right? By you, I mean your trades. And look at here. Over 20 years. The blue line, 20 years. All time. Over 20 years, this thing starts going up now. Nice. Okay. It's got a score of 4. And you're like, Wayne, it's only a buy. Let me tell you something. This is my opinion. If you get something that's a strong sell, you've already missed it. Yeah. Saju, yeah, I see it. You have to understand, if I don't respond to your question, it's because I'm actually looking at what I'm doing and not looking at the chat. So I go back and forth. So if I miss it, I apologize. Nothing personal. Okay, Aswin? All right, so if it's already a strong sell or a strong buy, where the hell have you been? Because now not only is all the fundamentals pointing up or down, but even all the technicals are pointing in the same direction. And like, you just woke up? Where have you been? I'd almost say strong sells and strong buys are a little bit too late. And most likely, you're going to, in a strong sell, you're going to open your chart and find that you're in a support position, and you'd be a fool to sell at support. So you have to wait for pullbacks. Well, in a scenario of like where it's just a buy or just a sell, what you're probably going to find is either mixed bag fundamentals, or even better, directional on the fundamentals, but the trend disagreeing. But what could go right is suddenly you find a buy. So you buy a dip. So this has been going up. So let's say there's a dip down to 38, and then you buy it and it works its way to 39.5 and eventually breaches back above 40. Well, once it gets back above 40, it'll go from a buy to a strong buy. And that would confirm your trade. You see? And I think that's how you should look at it, because if this buy gives you a bullish bias, there's only two things you can do. Are you listening to me? If there's a bullish bias, there's only two things you can do. Okay? You can buy a double bottom at support, or you can buy a higher low, what we call a dip. So you either buy the dip or you sell the rip. Well, selling rips are for bears. We're a bull. So you're like, okay, where's the dip? Well, it could drop back to 39.98 or 38. So it's going to drop to 40 or it's going to drop to 38. And if you buy the dip, if it drops to 40, by the end of the week, we should be at 41.5. If it drops to 38, we should be at 39.62 specifically. So you're probably going to find yourself over the next few days buying a dip. What? And that's probably a better op. So now we got to go find that. Let's go pull up that chart. Okay. And we already retested. That might have been your shot, bro. Okay. You remember? Look, let's put it together. Let's put it together. 39.98. I did this 10 minutes before I started this webinar. So an hour before NFP came out, it said buy at 139.98. Remember, that's math. It's derived from math, not subjectiveness. Oh my God. Oh my God. Right? Oh my God. That's what it said. Plan B is buy it at 38.01. Well, that's a heck of a ways down, huh? Well, that you want to pull back. So let me do this because it's a daily chart. Retail traders don't trade daily charts, do they? 38.01. Well, we're trying to get aligned with institutional investors. So you'd have to go out there. So I'm long at 36 something. And we're at 41. So I was up 500 pips or something, right? Cool. So plan A, buy the dip, which is actually Monday's day trade. But that's not a big deal. We need to add to this. So I want to change. We're not really interested in the day trade. That's so easy. So let's open my biased pivots. Bullish mode is correct. But let's look at next week's buying zone. Take a look at that. It says buy it at 39. So we'll mark it that way. So that's actually another plan B. 38 would be plan C. So let's do the next one. Biased pivots, give me the monthly entry. I'm just looking at entries, not exits. And, okay. Close, update. And, whoa. Whoa. Monthly is way down there. So typically what happens is you hit the target first and then drop. So what this is telling me, technically, because remember I'm a technician. Oh, let me change the color here, make it a little bit thicker. You know what? Let me do the arrow. Let's do this in black. Okay, what this is telling me is up, down, up, okay? And then what? Maybe something like that. This is not fundamental analysis. I'm only doing technical analysis here. Aswin says, will I get the report every week if you sign up and pay money? Yes. Okay. I think $50 a month is fair. So if you download the sample, I'll send you a coupon code. Once a week, you'll get an updated report. So this is just technical analysis. Now, the fundamentals don't suggest any of that. It only suggests this. But we're traders. We're smarter than an algorithm. I think you're smart money. You're a retail trader. I would never call you dumb money. I think you're smart money, but we also know that it's going to go up and then it's going to come down and then at some point it's going to go back up again. Institutional traders, I think, can be dumb, in which they just let it go up and then they ride it out and then they let it go up and then they ride it out. I could argue that institutional investors are dumb, but I don't believe they're dumb. I know many institutional investors and they're certainly not dumb. Aswin says, am I fundamentally focused or technical? Well, let me say it this way. This is my 197th month of doing this live stream at FX Street. That's 16 and a half years. So why don't you go and watch some of the videos on FX Street's YouTube channel? Because they're 3 hours long each. What? Yeah, it's going to be 600 hours. So hurry up. You better get going. But also on YouTube, you will find 6,000 videos associated with my work on the Trader's Way YouTube channel, on the FX Bootcamp YouTube channel, so on and so forth. So there's approximately 7,000 hours of my work. And what you'll find is I'm a well-rounded trader. I love fundamentals and technicals. Yeah, don't wind me up, Bubba. So I'm glad you showed up and I'm glad we've met each other. But you need to take control of the relationship. Which means I've already done all that stuff ahead of you. So now you got to catch up. I mean, it's amazing, right? They say, what, you need 10,000 hours to become an expert? And I've probably done 10,000 hours of live streams and webinars and presentations and speeches. I've probably done 10,000 hours of that, plus my trading. So what am I at? 100,000 hours of trading experience? Crazy, huh? It's ridiculous. I find it fascinating because I was there the whole time. And before this, I was dare I say, a successful entrepreneur. I thought I went back in my VC days and my entrepreneur days, right? I was I was doing stuff. I had a huge office. I had a huge following. I had this giant network of venture capitalists and lawyers and accountants, all in the high-tech industry. I knew hundreds and hundreds of successful entrepreneurs in the Silicon Valley. I was members of all the clubs, and then I ran my own, and people came to my stuff. I brought in coaches and lecturers and all kinds of things. I was a player in the Silicon Valley. There were dozens of magazine articles written about my work and my activities. Right? I remember being in the Red Herring. I was so happy. Or Tech Week magazine. Or Inc. magazine. I'm like, oh my God, I'm in Inc. magazine, Mom. The National Post of Canada did a featured article on me. I really thought venture capital in the Silicon Valley was my future, that I would die a Silicon Valley legend. And then I ran into Forex. Do you understand how crazy, amazing, ridiculous it was? I threw all of that Silicon Valley work and energy that I'd thrown into that. Just amazing. I threw all of that away and risked it all. My friends, my family, my reputation, and I quit my job as a VC, my dream job. I walked away from the community I was famous in and became a, quote unquote, just a retail Forex trader. Day trading, actually night trading, from my home office. 20 years later, here I am. Rock you like a hurricane. So I hope you fall in love with it as I do, and did. But I want you to also understand, I went all in. All in. All in. Not just money and time, but reputation. Threw it all on the line for Forex. So if you're biting your fingernails and wondering if you're making the right decision, well, if I've analyzed, thousands of business plans, I think this is the best business. But think of it differently. If you tiptoe into Forex, you're like, yeah, I think I'll give it a try. I went all in. I went nuclear. For me, it was the nuclear option. I took it to levels that were probably dumb. But maybe that's why I survived. Maybe that's why I survived. Nobody out hustled me. So I'm saying all of this not out of ego, but instead to fire you up, to show you that A, this can be done, but B, the level of commitment and focus and demand that it will take for you to succeed. And if you're thinking about yellow Lamborghinis and girls in bikinis, and forget it, you're a child. That's childish thinking. Getting rich quick is a poor person's dream and is very childish. But if you're like, I think I can do this, blood, sweat, and tears for years is normal for running a small business. I don't care what your small business is. It could be a big business like a farm. Dude, it's all sacrifice. It's all risk. So I want you to look at it that way. Your level of commitment is the test. Do you have it, what it takes? Okay? And I'll tell you, everybody thinks they do. Everybody thinks they're above average. And yet, what, 90% of retail traders fail? But you're different. Why are you different? Oh, God loves me. God loves a lot of people. Most of them are not successful. So, what makes you special? Okay? Are you the smartest? Maybe you're the smartest. But it doesn't mean you have what it takes. I would bet on work ethic every time. You don't have to be a rocket surgeon, but if you have a ridiculous, sickening work ethic, I would count you my friend. You might be a mediocre trader, but if you got work ethic, I would bet on you every time. Because 80% of the time it works every time. Shoot, 60% of the time it works every time. Hard work all day, every day. So you better be passionate, right, Arve? What kind of person thinks about getting rich quick? Cutting corners. How can I get there faster? What do you mean faster? I thought this was about mastery. How does the artist even know she's done the painting to put down the paintbrush? Because the passion doesn't end. That's the thing. You should be asking, what more can I do to become a better trader? What tools could I have to become a better trader? What can I do differently to challenge my thought process so I can become a better trader, so I can uncover and create more value? What more can I do? Zach, no, I walked away from the whole thing. So Zach said, did anyone from the tech world follow me into Forex? No. So I saw the 2008 financial crisis coming. I saw it, and so I left. We sold the stock market. We didn't sell the stock market. We got out of the stock market, took profit on much of our portfolio, and sold our house. We put it on the market in like literally one day. We had 8 offers. And of the 8 offers, 2 were in cash. 1 was in like less than 30 days closing. So we took that one. A month later, the housing market was crashing in California. I am not overstating it by saying I sold the house and 2 weeks later it was all over. I am not joking. You don't believe me and it doesn't sound believable, but that's what I did. I bought a new house and timed the mortgage payment, the closing, to the Fed cutting interest rates. Because I knew the day they were going to cut interest rates. So I delayed the closing and everything to close one day after the Fed cut interest rates. So at least I get that. And then later on, when things were worse, I was able to do, refis and playing with the money and all that kind of stuff and yada, yada, yada. And the stock market hadn't even crashed yet. It was 6 months later that the stock market crashed. And by the way, here's an interesting topic for you to think about. I remember 2008 like it was yesterday. Plus, I took a class at Harvard that talked about it. And it was so funny to read my life in a textbook. But anywho, okay, the market was generally up. Then we finally had the stock market decline. Then it was up all summer and then boom. And we're here right now. If we were overlapping 2000 and I don't know, was it 8 or 7? I can't remember. 2008. If we were to overlap 2008 with 2022, we're right here, right now. And about a week ago, I increased my hedge by triple. And I'm triple leveraged. I'm heavily short the stock market, but I'm also heavily long the stock market. So don't cry for me, Argentina. Plus, I saved money for 6 months to buy the dip. So I bought the dip, but I think this could, not will, could go lower. Okay? Yeah. So anyway, so now we got a plan A, which is really a day trade. We have a plan B, which is a swing trade. So let's do this. Day trade. Plan B is a swing trade. And plan C now, which is this one, is an institutional position trade. And this could lead to price action being like this. Okay, up Monday, down Tuesday, up Wednesday, down Thursday. Okay, double top in a week. Down here, and then up by the end of, by around the September Fed meeting. Wowzer. Or it just goes up. Something in the way. Cool. So as you can see, I'm long right in this gobbledygook, which we call a role reversal. Okay? So you have a bottom, a higher low, a higher high, and guess what I teach at FX Bootcamp? You get a higher low, followed by a higher high, you buy a higher low at a role reversal. Nice. Easy peasy lemon squeezy. Okay, buy it at 37. It's actually less than that. Buy it at 37, go for 44. But Wayne, that's 700 pips. Yeah, you don't like that? You don't like it, huh? I once made a call at the FXStreet conference in Barcelona, Spain, for a 5,000 pip move on the pound yen. And I was wrong. It dropped 7,000. So 700 pips. Cool. So anything else going on here? Okay. Okay. Institutional investors are heavily, right? Heavily short the yen and heavily long the dollar. And retail or not, institutions are pushing this up. There's a positive carry, right? You're collecting 2.6% on the swap. That's nice. That's a good carry. You're like, Wayne, I don't get it. What does that mean? It means this. Are you leveraged 100 to 1? Well, minus some exchange fees and other things that go into the calculations at your broker. But let's just dumb it down and say if you're leveraged 100 to 1, you earn 2.6% times 100, which equals 260% a year paid in your account on the margin that you used to begin with. So if you made a mini trade, so let's say you traded one mini, and the mini required $100 of capital. so that you can control $10,000 in investment. Well, you're getting paid interest on your $10,000 investment, but you only have $100 of your actual capital. So, roughly speaking, at the end of holding this position 1 year, just in the interest that you're collecting, you should get somewhere in the neighborhood of $260 in interest collected on your $100 investment. So let's say 365 days later, you get out of your trade. Well, you get your $100 back because that's your margin. Plus, you'll have 260% added to that account, or you collected it every day, but you'd have $260 more just on interest paid to you. Okay? Brad says, dude, it can reverse overnight, positive 1 day or negative. Not swap. No, that's wrong. Okay? And this doesn't include pips. So if you were in this trade for 1 year, you probably have a lot of pips, and your pips are worth more. I'm just suggesting you can earn, when there's a positive carry like this, a very handsome return on your money. And that's part of what's going on in institutional trading. So you're like, with institutional investors, when they hold for months, they're collecting. No, Brad, no, not on swap. Swap doesn't change that way. No, we're talking swap. We're talking interest payments. We're not talking about markets. We're talking about interest. The Bank of Japan and the Federal Reserve only change interest rates 8 times a year. And because Japan, Bank of Japan, is initiating yield curve control, they don't want to raise interest rates. But the Fed is definitely going to raise interest rates. So this swap is going to get better and better and better. So by the end of the year, you could be earning as much as, let's say, 350% annually, paid every day. So you get every day, you get 350% divided by 365 every day, and that adds up. So, right? So there are people here that can confirm this, but I once did an example trade on my trading account. I think it was either Turkish lira or South African rand, but I held the trade for 9 months. Okay. I made 0 pips. Oops. Okay. I made 0 pips and an internal rate of return of 1,000%. Thank you, Jim. 9 months. I broke even, and my internal rate of return was 1,000% because I collected swap. Oh my God. Oh my God. Yeah. This was before COVID. Well, yeah, well, A, the swaps are changing, but B, liquidity providers probably trying to cover their costs too. So remember, it's all about the liquidity providers. It's not the broker. Well, obviously the broker could, but I don't believe that to be the case with Trader's Way. Also, excuse me, I'm advising a hedge fund, and I can tell you when they're working with their brokers, you negotiate this stuff. What can I get for 100M? Okay. Yeah, if you're going to drop money into a broker, into a prime broker, you negotiate. You negotiate things. What do you want? What do you don't need? And you might ask for, full swaps. Okay, cool. Okay. Also, Henry, you'll probably find there's different swaps on ECN accounts. There's different swaps on small accounts. So like if you got, let's say $2,000 in the account and you're trading mini lots, okay, you're probably not going to get a great swap. And this is for all brokers, right? But if you had $2 million in the account, okay. I once advised a Forex trader on their trading. They had some questions. And I'm like, well, give me access to your account. And so he sent me an FXCM UK account. And he gave me the login password for it. And it had something like 30, I can't remember. It was 20 million or 50 million. We'll say 20 million. He had $20 million in his FXCM UK account. I just couldn't believe it. I'm like, you have a retail account? And they're like, no, it's institutional. Okay. I was surprised that he had that kind of money in the account and not in like directly a bank, right? But he might have been able to negotiate really good terms and collect full swaps, have narrower spreads, and all that kind of stuff, right? Because the spreads could be narrowed down and all that kind of stuff. And so I imagine for 20M, FXCM will give you almost anything you want. Will probably even buy you dinner. Models and bottles, baby. Okay. And that guy was, I think, probably the worst trader I've ever seen. He was so bad. It was so stupid. He would sell at the top and buy at the bottom, sell at the top, buy at the bottom. And I'm like, dude, you're losing millions and millions and millions and millions of dollars. So he had 20, but he was losing millions of dollars like in very short, like every month, millions. And I'm like, oh my God, what are you doing? And he's like, it wasn't a big deal to him. And that was that. I said, look, that's your problem. I'm like, this money is just nothing for you. And you're doing a horrible job and you don't even care. I'm like, I don't even know. I don't think you're coachable. And then I advised him to move money out of FXCM. Sorry, FXCM. And he ignored me. He just was not coachable. Yeah, we can do the S&P 500 again. We'll just very quickly look at it. Okay. By the way, download the report, guys. Especially even if you just want the coupon code. I'll email you a coupon code. Lifetime, not a one-time deal. Lifetime coupon code. Hey, look at this. Somebody is spamming FXStreet, trying to steal you away to go do their YouTube live stream. What kind of person would think, and I hope they're listening right now, the person that just posted it, got blocked, but what kind of idiot would think that spamming somebody else's live stream would work? How dumb would you have to be to say, hey, you should leave this live stream, come watch me? Because I don't have any money. I can't afford ethical advertising and promotion. To that person, you're so pathetic. You're embarrassing yourself. And more importantly, your mother would be ashamed for your behavior. I ain't got no money, but you should go watch me trade. How pathetic. So anyways, you guys can't see it because it got blocked and the moderator killed it. But I hope that person heard me. Your mother would be embarrassed about your pathetic behavior. Trying to suck life and love out of this community to go get your own. How terrible. Right? So anywho. All right, cool. So yeah, the stock market, there's the analysis. Go ahead. We already covered it, so you can get back there. But yeah, why don't we take a look? For this, we're going to do a little journey. Little journey. Hang on. Little journey. Let's do a virtual field trip. Tradersway.com. Here's an ethical, trustworthy broker if you need one. Tradersway.com. I'm going to flip this over to MT5 so that we have access to the stock market. And right around, oops, delete. Oh, let's get it. Hang on now. There we go. Okay, right around here, I got triple leverage short the S&P 500. Nice. Okay. Cool. Now notice what happened here. Let me highlight this now. I got to get the drawing line, and I'll try to use the similar color. You see the line I drew before it happened? Watch this. No. I drew it before. Trust me. Oh my God. Yeah, I drew it before. Trust me. And see what happened? Lower low, lower high, drop it like it's hot. Thank you, Jackson Hole. Cool. So now we're stuck in the mud here. La 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 la. So it's going to fizzle out here for a while. And at some point it'll make a lower high. At what point will it make a lower high? That's your job, dude. That's the whole thing. That's the whole thing. Wayne, when do I sell it? That's the whole thing. That's the question. I'm not your money manager, so I don't need to make my guess. You make your own guess. Most likely, it's one of those levels. I would also look at pivot points and all that kind of stuff, but just looking at basic price action. But then how do you know? Maybe I should buy it. How do I make a determination of that? Does anybody know? How about you look at the fundamental data? Okay. Maybe you look at seasonality. Okay. Maybe do stuff like that. I have QuantBox open actually right now. We can take a look at, so this is the live data. Right? You see it? I'm actually logged into the cloud. You can't get into this. Okay. We can see what's going on right now. Where's the money flowing? So it's gathering the data right now. It's looking at the market. 38 markets. And it just went, oil is up 3%. 10-year T-note The yield is down 1.29%. There's everything in the middle. Cool, right? Take a look at the world here. So this is, again, just the organization of the world analyzed quantitatively. CAD yen is the strongest to the upside. Gold is this right? Hang on, I didn't get it all. There we go. Euro USD, pound USD, pound CAD, Euro CAD, pound Swissy. Sell, 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 sell. So it's organized that way. So we can see if anything's changed. So I have this S&P 500, Dow, FTSE, DAX, Nikkei, and the T-note. But we can see if anything's changed real time with the news. It doesn't seem to, right? Same numbers as before. Cool. Taking a look at like oil is still way up there. Let's get rid of oil. Actually, let's just look at the major pairs here. Okay. The biggest movers here currently. Okay. Now, what it's telling you is it was thought that they would do poorly, but they're doing okay today. When you add in the minors, okay, the things that are expected to do well are these ones, and they are doing well. The things that were expected to do well that are disappointing today are down here. The things that were supposed to be bad and are doing bad are over here. So pound CAD, pound Aussie, pound Kiwi. But dollar's not as strong as thought. Anyways, so taking a look at that. So everything, right? These are doing less good than thought. Okay? And these are doing as bad as thought. These are doing less good than thought. These are doing as good as thought. Does that make sense? This is where bulls want to be. Oops, let's do it in pink. This is where bulls want to be, and this is where bears want to be. This is a disappointment, and this is a disappointment. So right away, though, you might say, well, this actually might be tomorrow's trades. These might be next week's trades, right? And these ones are already hitting. They're hitting targets, bro. You should have been doing it yesterday. Why didn't you do it yesterday? Why were you not doing this yesterday or the day before or the day before? These guys are getting paid. So now if you do it, you're probably too late. But this might be the future opportunity where this could be going this way next week. And these are probably the best opportunities. So you got to think. Because they're blue because they're supposed to be bullish. They're supposed to be over here in the positive numbers. See? Growth, contraction, growth, contraction. So it's simple calculus. Right? You have your axes. Okay? And what we want to do is move this data set there. So you're like, okay, these are all down right now, but they're supposed to be bullish. What do you mean by supposed? Okay, there's, right? So anywho. The information's here. Cool. So let's do some Bitcoin. Let's get back over to Bitcoin. Bitcoin. Talking about Bitcoin. Bitcoin. Cool. So I was short this the other day. Nice. It's fizzled out. Okay. So there's my roll reversal. And then there's another one here. So looking at this using technical analysis alone, as long as we're here, we're bearish and aggressive. To really get a better sense, you should be on a longer time frame. Okay, 4 hour or a daily. So let's do daily, zip into here. And what I stink is this. Okay, currently the sell is around 2150, but I believe that's falling. So you got to project that 21 EMA. I'm looking at this right here. Forward. Now we could have this go up to 2150 and then drop. And that's perfectly fine. And I already have this outlined. And I did that 2 weeks ago. Okay. So now what could be happening is that we stay below here and we just move sideways while the 21 catches up. And then we drop like a ton of bricks. And we drop a couple of $1,000. So the thing is, this is a lagging average. So let's remove that. Let's go Insert Indicators Custom. And I'm going to add my zero lag moving average for the 21 EMA. Okay. I'm going to make it fat. But let's make it a different color and make it slightly different red. Well, no, slightly different. I don't know. What should we do? A lime green. It's going to be hard to see though, right? Let's try it. Okay. So currently it agrees. But in the future, it's going to, let's see if I can do this in a lime green. I can. Okay. In the future, this is going to catch up faster and probably hit around here. So which I would guess right now is in somewhere between 2 and 3 days, Bitcoin drops. Now, it's not me. That's not my guess. It's not, I mean, that's what I said, but I should reinterpret what I said. That's what the charts say. Okay. Okay. And then the breach. This matters, huh? The breach mattered, huh? So if you had some fundamentals behind you, one idea that can produce is like you think Bitcoin's going to go down. So when you breach below, that's your sell, right? Stay short, stay short, stay short, stay short, stay short, out, in, stay short, stay out, in, and stay short. But you'd have to have the bearish point of view pre-established. It wouldn't make decisions for you. That's what your job is. If you're using an indicator to make decisions for you, then you have no value. So you should quit. You're not even thinking about it right. Why did you make that trade? My MACD told me. Well, then your MACD is a trader and you are not. You have no value in the relationship. What happens if you don't add value to the relationship? You get dumped. So we got to use all this information to make decisions. Well, the MACD might be doing it right, Thiago? I'm just saying if the MACD's in charge, you're not adding any value to the relationship, so MACD don't need you none. To the left, to the left. Don't for 1 second think you're irreplaceable. To the left, to the left. Okay? So it's like even with QuantBox. If it says strong sell and then you walk into the market and sell it, you don't get it. You don't add any value. This report is correct. That is the sum of the fundamental analysis of macroeconomic data, fundamental analysis of money flow, right? And fundamental analysis of technical trends. It's correct. But if you just look at this and say, Wayne told me to sell it, you're not adding any value to this relationship. And you're going to lose money because you're not doing it right. You're not thinking about it right. You have the wrong attitude. Maybe you're just lacking the knowledge. You need to spend more time learning and less time doing because you're messing up something beautiful. And so instead, if it said silver down, let's say it said sell silver. You have to understand selling silver at monthly M2 is got to be one of the dumbest things you could possibly do. Really? If you sold it there, I don't think you understand how to trade properly. So you're adding no value. You're actually decreasing value. So you need to stop trading real money and invest time and probably money into education. And you would say, well, a better sell might be on this roll reversal. Oops, I'm trying to get that straight. Right? Or at the central pivot, or at the EMA, or at the M3. Which one is it? How the heck would I know? So they're all opportunities you need to technically analyze. I'm on a daily chart now for silver. So now you mark all these areas in which you might consider selling because you're fundamentally bearish. So now you mark these. So I guess we should just do it that way. You mark these. Wayne, how do I mark it? Well, just like I did these other ones. So let's say that's an op. Okay, that's an AO, right? An area of opportunity. There's an AO. And the next one is here, and I don't need more than 3. If you have more than 3, you're drawing so many lines that you have no idea what support and resistance is. So there are my 3 ops, my AOs, areas of opportunity. Okay, fundamentally bearish. I get a strong sell signal. I open up my charts and I'm like, Mama didn't, right? Mama didn't create no fool, right? Mama didn't raise no fool. So the question is now, technically, what would you do if this then double topped and dropped? That's your job, dude. Darlington, you're so late, I'm not going to do it. So subscribe to the FX Street YouTube channel, and we can start early. Or how about this? It's probably a waste of time, actually, but you can get my thoughts right here. but you're late. Okay. So anyway, so your job, guys, is to say, well, what's your bias? So you walk into this and your bias is bearish. So now what? You sell double tops or you sell lower highs. What else do you do? Nothing. There is nothing else. So your step one is identify resistance. I already did this on a daily chart. Step two, sell a double top or a lower high. What's going to happen today? It's either going to make a higher high, lower high, or double top. Two of those I can sell. One of them I walk away. Can you do that? Can you do it on a 5-minute chart? You're probably wondering what the red and green lines are, right? Okay. I can do it for gold, not for silver. Let me close all this. Okay. Why don't I see it? Oh, there it is. Okay. You see the continuation of the mean and deviations, right? Variance and the square root of the variance of the, right, of the mean. And it's not just the mean, it's the slope of the mean. So this is doing two things. It's, I have to back out further to do this right. Okay. It's calculating the standard deviation, and it's calculating linear regression. Okay. So there's two different calculations in there. It's pretty, right? The thing is, I want it to do it automatically, and I want it to keep changing. So if I just drew those two studies, you're like, ha ha ha, Wayne, I got your free tool for free, but I'm going to do it myself. Oh. Members of FX Bootcamp get that for free. It's called price action pivot points. So what it'll do is as price action inevitably changes, either more bullishly or becomes less bullish, they update in real time. They're pivot points based on price, not on market. It doesn't look at yesterday. It doesn't look at a week ago. It doesn't look at a month ago. It doesn't look at what happened last year. It's only looking at price. They're price action pivot points. I invented them. They're mine. Cool. You can have them for free if you join FX Bootcamp. Once again, $88 for a whole year, including 65 hours of training. And not just like me doing like videos like this. No. Lectures. 65 hours of lectures. Coco says, does a long-term chart affect the 5 minute? No, but the technicals do. So for example, I would assume around whatever this price is, 1780. I don't quite have a price on it. Around 1793, I would expect short-term up. And I would expect it to go to 1893. So, yeah, $1 of up on the small time frame. Okay. So you could, you can incorporate this. But think of it, though. Let me handle that question. Does the long-term time frame bias affect the 5 minute chart? Let's do it this way. No. No. So if you love trading the 5 minute chart, by all means. But you are not trading fundamentally. That's it. You're right. You're not taking in consideration the flow of institutional capital and the flow of capital around the world and the change in positioning. You're not paying any attention to economic data and its impact on flow. You're not paying attention to interest rates or inflation levels, central banking policy. You don't know anything about the Bank of Japan's yield curve control policy. You don't care that the rate and velocity of the Fed interest rate hikes, nor are you aware of the neutral rate or the terminal rate, or where actual GDP is versus potential GDP and the closing of gaps. And you're like, you just don't care. It's all on a 5 minute chart. Cool. Do that. No, it's not like gambling. No, I wouldn't go that far, Brad. But the likelihood that 5 minute chart account produces a yellow Lamborghini and models and bottles is basically zero. Yeah. It's really, really hard work for very, very small amounts of money for very high levels of risk. Now, that might work for some. I know I'm being condescending, but I only mean it from my point of view. I don't mean it to the person doing it. I don't like that type of trading, but I think you can do it. I just don't understand why you would want to do it. Why would you not want to know? Why would you not want to understand? Why? It's a different point of view. And I'm not here to say that one is right and one is wrong, but I can tell you that institutional trading will lead to much bigger money. But it requires value creation. You have to be able to talk about what's going to happen at the end of between now and the end of the year, how you're going to position yourself next year, what are the key indicators that you're following to look at, changes in economic conditions and monetary policy and positioning in the market. Like, you have to know a lot of stuff to create value. And then you have to have a lot of skill to be able to carry out your strategies. But sure, you could know nothing and trade a 5 minute chart and chase price. I wish you the best of luck. Okay? I know, right? I know people that make millions of dollars a year trading Forex. None of them trade like that. None of them trade a 5 minute chart knowing nothing. Instead, when I have dinner with them, we have like fabulous conversations. What do you think about this? What do you think about that? Well, what if they do this? And what if that? And what if that happened? And what if this? And we're talking and we're debating and we're like, about the variables that impact our models. What do you think about this? Well, what if that happens? Yeah, and actually, and we do, but those are all sort of risk and responses to them, right? But you're very much correct, Richard. Right? You're very much correct on that. Because that's what their clients are worried about. So, but I don't know anyone making serious money that, trades 5-minute charts. Now, I can tell you that some of the funds run algos that do trade volatility strategies. So maybe they take some money out of the market in a very short amount of time, like literally seconds or even less than a second. But they're not focusing on trading price action or mean reversion of price action on short time frames, because the cost of doing that kind of business is just too high. Your spreads are too high because you're only making, let's say, 10 pips a trade, but one or two of them right off the bat just goes to the spread plus some sort of slippage. You're not getting any carry. And the risk is that you have 5 good trades and 3 bad trades, and then 6 good trades and then 2 bad trades. And they all kind of wash each other out over long periods of time. So the only way to make money is to then jack up your lot size. And it's death, dude. It's death. It's cliche. That's how to blow up your trading account. But yes, you could do it. I don't understand why you would want. Yeah, Coco, understood. Yep, understood. Peter Pip says only increase lot size when trading plan requires it after scaling up. Or I would say after scaling up. You're increasing your lot size by scaling up. But the thing is, let's pick on this. Let's pick on what we're looking at here. Okay, you see a triple bottom. And you're a bull. Can you buy a triple bottom? Bulls can buy, right? Double/triple bottoms and higher lows. So yes, so you go into this position in this trade. Okay. Now it's only a 5-minute chart, so forgive me. This could be an hourly chart or whatever. But let's say you go into this. And your quant box says bullish. Okay, great. So you're a bull. You can buy in here somewhere. Let's say you bought the first one, your stop's down here, so you're 5. Great. Double bottom. Then you're up here and you're interested in buying a higher low. You're looking at a roll reversal. So you're profitable on the first one, move your stop to break even. So you add a second one. You have 2 lots now, but only 1 lot risk. This first one doesn't have any risk anymore. Okay? So now you're waiting for a breakout, higher high, higher low. I'm trying to get this right. I'm not trying not to cheat. But so anyways, no high, no high, no high, no high, no high, no high, high. Okay, higher high. What do? Oh, you can buy a higher low. So you're going to look at the roll reversal. What used to be resistance is now support. Cool. So now you move the second stop to break even and the first stop to positive. So now you got this much profit on one and 0 profit on the other. Makes a higher high. What does one want to do? Wants to buy the higher low. Cool. Let's do that in a different color. Okay. How about near the roll reversal? Okay. There's the roll reversal. So you add a third trade. Okay. Move the stop on the first one. Move the stop on the second one. Move the stop on the third one to break even. And so now you got this plus this. Makes a higher high. Okay. You want to buy a higher low? How about a roll reversal? So you put one here. Now you got 1 trade, 2 trades, 3 trades, 4 trades. Now you got your 5th trade. Now it's going up. Move the stop on the first one to here. Move the stop in the second one to here. Move the stop in the third one to here. And the 4th one, right? Boom. So now we're higher high. You can move the stop break even, the third one to a small profit, the second one to a big profit, the first one to a huge profit. The thing is, you'll only ever risk one trade of risk. So you scaled up position, as Peter's talking about, but never with risk. Because this trade one, once it's profitable, is opportunity cost. Second one, once it's profitable, opportunity cost. Third one, opportunity cost. Fourth one, opportunity cost. The first one, your stop is probably not at break even yet. Actually, it is because it's up here trying to make a higher high. So now you can jam the stop. So now you got 5 trades and no risk. You have 5 open positions and 100% available equity. You'll see that in your account. 100% of available equity, which means you have no risk. What an idiot does is drops 5 lots on one trade because they ain't making no money on their pissy little trades. So maybe if they jack up the money. No, your problem is your trades suck. You have pissy little trades. Not that your lot size isn't good. So now you got to have 1, add a second, add a third, add a fourth, add a fifth, and you scale up big. But to do that, you're going to have value, which means based on your hardcore analysis, you believe you know where this is going and why. So now that you understand why it's going to go up, you have the strength and fortitude to get out of bed and do what needs to get done technically. You know how to trade, but you also know why you're making the trades. And you will never, ever, 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 ever become a professional trader if you don't know why you're making trades and why, because you have no decision-making process. You're only looking backwards at technical analysis, and you're not going to be able to have a conversation with an investor. They're just, it just blows me, right? Like you would reek. It would turn people off. Please give me $1 million. What's going to happen next year? What do you think about the Fed? What do you think the stock market's going to do? What do you think about this? And if you spit out facts that you've gathered through your research process, now you sound like you're intelligent and you're making wise investments. Okay? Now, maybe you're just spitting out stuff you found on QuantBox. Oh, well, if you look at, like, let's go like euro dollar. Interest rates favor the United States. Employment favors the United States. Inflation favors the United States. Trend favors the United States. Seasonality favors the United States. Retail sentiment favors the United States. COT data favors the United States. And you're buying it? What is wrong with you? Oh, well, I'm on a 5-minute chart and it's going up. Oh, okay. Well, go ahead, pick up the pennies. Huh? You're cleaning up around the big boys. Okay? You're cleaning up. Cool. Go ahead, clean up, tidy up. Okay? Clean up the mess. You go ahead, make your 20 pips. Meanwhile, what are institutional traders doing? Oh, they sold here. Let's do this in yellow. They sold here. Let's do a little more. Okay. They sold high. They sold here. They sold here. They sold here. They sold here. And they're preparing for another sell soon, probably here. So you're going to go ahead and make 20 pips. They're making thousands and thousands and thousands of pips. So you do you. But ask yourself, what would you rather be doing? Would you like to make a change in the game? Because I just went over a 5-minute chart Do you understand how you can do the same trading on a 4-hour chart? Do you see? You have a top, lower low. What should you do as a trader? You're a bear because you analyze the macroeconomic data. Bears sell what? Double tops and lower lows. Okay, there's a lower low, sell the lower high on the roll reversal. Done. Lower low, sell the lower high at the roll reversal. Done. Lower low, sell the lower high at the roll reversal. Done. And you want to trade a 5-minute chart to pick up 10 pips here, 12 pips there. Really? Really? Seriously, you think that's the best way? I think it's the best way that you're surviving right now. But if you had more information, you could have more valuable trades because your analysis that you're doing creates more value. It's the secret sauce to all successful businesses in the world. I'm mentoring somebody right now with a drug problem, or used to have a drug problem. So they come over to my house and I made them dig holes for days, just digging holes. And what I said was, right? For a $5 plant, I expect a $10 hole. Okay? I said, if you ran a business digging holes, because I think that's all you're capable of right now. If you created a business, yes, it's hard. Yes, it's difficult. Yes, it's hot in Georgia. Quit your bitching. Dig a freaking hole and make it beautiful. And I said, you could start a business like this. Okay, let's say it's a $5 hole, because I think that's the number I used with him. I said, if you dug $5 holes and charged people $1, you would very quickly gather a huge following of people talking about you like, oh my God, you need a hole? Let me send you this guy. I know this guy. He digs awesome holes and he charges $1. You won't believe how beautiful these holes are. And you would be in demand. You're digging $5 holes and charging $1. People look at it, not only do they have a hole, but they're getting $4 extra value. People will love you for it. They'll praise you for it. You're the artist of hole digging, an artisan. I actually told him when he was done, I said, that is a beautiful hole. You're like the Michelangelo of hole diggers. If professional hole diggers saw you digging this hole, they would be ashamed at the holes they've been digging. So I gave him praise. But I said, what'll happen after a while is you'll have all this business. There's no way you can dig that many holes. So you'll start charging $2 a hole. People are still happy with the holes, but you start paying other people $1 to dig the holes. Now you don't dig holes. Now you have a successful business that is constantly in demand, constantly providing value. All of this is true for everything in life. Life is like that. If you wake up in the morning and make the world a better place, you've added positive energy to the universe. Thank you for helping. But if you're shaming people on Facebook or faking how awesome your life is on Facebook, you're sucking the world dry. That's my personal point of view. Forex requires hard work and focus, discipline, and sacrifice so that you can make better decisions on facts. That's the value creation. And then you'll have the strength and fortitude to get out of bed and sell the lower high if you're a bear, or buy the higher low. I know when I show this chart to you, you're like, oh my God, that looks easy. But I also know you didn't do it. So what's the problem? I think you're smart enough. I think you're good enough. I think, gosh darn it, people like you. But you need to add the sickening, ridiculous work ethic and make decisions based on fact, not just throwing down a bunch of trades. You need to focus on value creation. You need to ask yourself, what more can I do to create value in my successful foreign exchange trading business? What more can I do? What more can I read? What more can I learn? How can I challenge myself more to be the best I can be and keep moving the bar of how best you can be? And that means you're always doing a little bit more than you possibly can. And do that blood, sweat, and tears for years, for decades, for the rest of your life without relent. And the only way to do it is passion, love, and passion. Because love and passion creates value. In some scenarios, love and passion creates a baby. It created matter from nothing. Right? You can change the universe. In that case, you're creating a universe. I did it a couple of times, and now these people run around my house. And they're amazing human beings that I love and care for. And they're going to grow up and do amazing things in this world. But that's what a small business is like too. That's what your Forex trading business is. You will see, you will get to the point where it's making you money and changing your life, but changing the life of your loved ones around you. The world will change. The world will change. The world will change. You'll see things differently. And you'll move to a better neighborhood. Your kids will go to a better school. You'll save for retirement. You'll save for a rainy day. You'll try the fun things you always wanted to try, but then you'll come up with new interesting things to do with your life because your watch and your car and the size of your TV is not that interesting. You'll move beyond that. You'll get that stuff. You'll try it. And you're like, oh, I need to have a Rolex. Dude, look, I have this Rolex in my drawer. Is it even still here? I don't know where it is. It's been in that drawer for 15 years. It doesn't make my life better, but I did it. Why? I always wanted to be a guy that owned a Rolex. Now I own one. Now you do other things like make the universe a better place by giving back to the world logic, information, experience, love, passion, and inspiration. And do it every single day, forever. Oh, that's kind of like what I've been doing. And I got a lot more than I want to do. I'm just warming up, baby. This is only year 20. And it's been a good 20 years working with FXStreet. This is 16 and a half years of this one webinar. So again, I'd like to thank FXStreet for being a wonderful group of people that have put together an amazing website that helps retail Forex traders like us. If you like my style of training, FXBootcamp.com, you'll learn this price action stuff and way more than that. Way more. I'm telling you, if you join, it's $88. You watch the 65 hours of training videos, I swear to you, you will believe they're worth at least $1,000. I'm giving you, in my opinion, $1,000 worth of value for $88. I am not joking. Cool. There's my contribution to the world. If you need a trustworthy, ethical foreign exchange broker, Trader's Way earned my loyalty and respect when the Swiss National Bank pulled the peg on the euro, and big big brokers went out of business instantly, losing hundreds of millions of dollars of money, hundreds of millions of dollars of value. Apparently, they were trading against their clients. They're gone. Good riddance. Trader's Way, a boutique little foreign exchange trading brokerage, were perfectly fine. Apparently, they're not trading against their clients. I like that. Tradersway.com. And QuantBox. Oh, yeah. One more thing. QuantBox is brand new. You're the first people outside of FX Bootcamp that have access to this. Sign up for that report that I just used today. It's just that report. There's nothing else. There's no sales stream. I'm not going to send you all this crap. But I will send you an email that will give you a lifetime discount for QuantBox on the retail version. That's it. I'm done. Have a wonderful weekend. Peace on earth. May the pips be with you. May your profits be above average. Take care of y'all. All y'all.